Thank you. Welcome, everyone, to the infrastructure monitoring session. I'm extremely excited to be moderating this panel. Not that it's a competition here, we're all on the same team, but I should say that this panel was the first to get full registration when it opened. So clearly, a lot of excitement around the topic of responsible investment in infrastructure. Why is this such a popular topic in session? Well, I think we all understand that there are some natural ESG elements to infrastructure. They provide vital services to communities, they enable economic growth, they're often regulated, and so a lot of the classic ESG topics that might apply to other asset classes are sort of already built into infrastructure. But at the same time, there's a sense that we don't have a common understanding of what responsible investment in infrastructure really means or is, or how to actually put it into practice. So into this void, the PRI is stepping boldly. They established the Infrastructure Advisory Committee this past year with a twin mission of developing an industry-wide understanding of responsible investment in infrastructure, but also, very importantly, going beyond just having an understanding, we want to have an expectation among asset owners and investment managers about how to put this into practice. So a couple key deliverables from that work stream. One is LPDDQ, building on the work done by the Private Equity Committee. The Infrastructure Advisory Committee is going to have one adapted for infrastructure. Look out for that to be released around the end of the year. And then, very importantly, a primer on what it means to actually put these elements into practice, which we're expecting to complete by the end of 2017 with launch events in Q1 of 2018. If you have any questions about this work stream, please reach out to Hilke. Hilke, please raise your hand in the front row, and she'd be happy to tell you all about our work. So first thing, we want to start with some polling questions. We've been told that the polling app might take a few minutes to have a delay, so we're going to go to the age-old style of just raising your hand. So first question, to get a temperature check on infrastructure. Where along the ESG integration maturity curve is your organization on infrastructure? So the four options are starting from scratch, we have a policy and good intentions but with limited results, some limited results but not consistent or at scale, and the fourth, ahead of the curve and trying to maintain best practice. If your organization doesn't invest in infrastructure, channel what you think your imaginary organization would be at if you were actually there. So first option, raise your hand for starting from scratch. All right, just a few hands. Second option, we have a policy and good intentions but with limited results. A few more, maybe 6 or 7. Third, some limited results but not consistent or at scale. Many more. Looks like maybe 10 to 15. And then last one, ahead of the curve, trying to maintain best practice. All right, looks like 10 or so, which means about half the room didn't vote. That's good. But what we're seeing is a nice scatter across all four of these answers. Let's go to the next polling question. Nope. How would you characterize, same answers. How would you characterize the current set of efforts by the mainstream infrastructure investor to influence an asset's approach to sustainability? Same options here. Starting from scratch, please raise your hand. 1. Second one, we have a policy and good intentions but limited results. A few. Third, limited results but not consistent or at scale. And ahead of the curve, but trying to maintain best practice. Only 1. Very good. Okay, let's actually get into some real practitioners' insights into these topics. We're going to start with Joanne Saleeba from HESTA. And the idea here is to give a bit of a sneak preview into how some of the leading practitioners of responsible investment infrastructure are actually putting these ideas into practice. They have about 5 minutes each. They'll start with an introduction of themselves and their organizations, and then get into some case studies. And we'll go through each and then open up for questions. I should say that we want this to be dynamic and interactive, and so in your app, you actually have the chance to pose questions. And not just pose questions, but also vote on the questions that have been put out. And so as you upvote certain questions, they'll get prioritized, and I'll make sure that I address them to the panel. So please, Joanne, if you can kick off with HESTA.
Thanks, Adam. Thanks for having me here today. It's a pleasure to speak to you about our infrastructure, what we're doing on responsible investment in the space. I am with HESTA, which is the community health and community services sector superannuation fund from Australia. We're one of the largest growing funds and one of the largest in Australia. We have approximately about 40 billion in assets under management in sort of an internationally diversified portfolio. Just to give you some context, we have about 50% of that in listed equities, and currently about 10% of that sits in infrastructure. So it's just a reasonably sort of important but small component of our portfolio. We have 820,000 members. Each of those members has a choice in where they put their superannuation, which is an important factor, I guess, in the landscape of the Australian superannuation industry. And 80% of our members are women, so that also affects sort of some of the areas of focus for us, and really how we align, with our members. We have a long and strong history of responsible investment at HESTA. We committed to the Principles for Responsible Investment back in 2006. We've had a dedicated sustainability or responsible investment sort of role since 2007. That team expanded from 1 person to 3 last year, so we're really excited about that, and I think it's kind of indicative of the important growth in the area. Importantly, responsible investment is grounded in our core investment belief to generate, long-run sustainable returns to members. But more importantly, the board really more recently has focused on also impacting the sort of environment and society into which our members will retire. So it's not just about what's their monetary outcome are they going to get from us, but really how are we going to help contribute to a more sustainable society and environment. And that's, I think, an important sort of progress in our thinking about it. We're a 100% outsourced investment model, so we do all our investment through external managers. And then really today I just want to share with you, I guess, my role and the sort of oversight that we provide to managers, in the face of that sort of outsourced investment model. So I'm going to talk about predominantly our manager assessment framework, how that's evolved over time, and I guess, just touch on the fact that, the development of that assessment framework has increasingly highlighted the importance of the ongoing asset management within that process. So my role is really across all assets. As I mentioned, I guess there's 5 key areas that I work. It's setting policy and strategy. It's working with the asset class teams to assess our managers and support them in the investment decision making and processes that they undertake. It's working on active ownership. So again, with that 50% of funds under management, listed equities, corporate engagement, proxy voting, and advocacy of really important elements of our work. And finally, the member communications area is very important, trying to communicate all that we do around responsible investment, make it sort of tangible to members. So just touching on our manager assessment framework, really, when I joined HESTA 6 years ago, it was a conversation that we had with our managers across all asset classes. So it was nothing formal, and it was really just wanting to make sure that each of our managers understood what ESG was, that they were thinking about it in their investment processes, and that they were aligned with the views of HESTA as being a long-term investor. Over the time, it's grown to more than 37 different criteria across 5 key kind of categories that we look at. So the key categories are strategy and risk, investment due diligence, ESG resources, whether they be internal or external to the organisation, asset management, monitoring and reporting. So 37 criteria in those areas. The the framework really came out, I guess, the learnings we got through the equities, the listed equities area, because that was where we first introduced our manager ESG assessment. But I think, some of the work that's been done across the asset class teams by the PRI has been influencing those criteria, particularly the private equity due diligence questionnaire. I was on the working group for that, and that was really instrumental in helping shape, I guess, some of the nuances and differences as we took that into the real assets area. We introduced a scoring methodology into those sort of questions and criteria, and the purpose of that scoring is not about just adding up the different criteria and coming out with a number at the end and saying which manager do we think is best. It's really about taking each of the individual criteria, setting what we think our expectations are for each of those criteria, and assessing our managers as to how they perform against those criteria. That way, what we get at the end is a gap analysis where there's a higher number. The greater the gap is where we see that there's opportunities for improvement in our managers' performance in that criteria, and that it also shows us where our managers are doing really well.
Joanne, I'm sorry to interrupt, but we'll have to maybe wrap with the last point, and then we're going to move on to Isabelle.
And I think some of the recent enhancement is really just the weighting of those and really applying a greater weighting to ongoing asset management in infrastructure, and also providing more feedback to our managers. So we've developed a feedback sheet which shows where our managers are performing well and where they need to improve. There's a heat map as to how they compare with other managers, and we're also reporting this information up to the board now. So it's just really, I guess, become much more formal and much more comprehensive.
That's great, very interesting, and I hope during the Q&A session we get into maybe the guts of that process, and maybe you can share an example of when you feel like that engagement was really meaningful and you saw some meaningful change from a manager. On to Isabelle, Combarel from SWEN Capital Partners. Please go ahead.
Thank you, Adam. I'm also very pleased to be here today and to speak with you. So I'm Isabelle Combarel. I'm working for SWEN Capital Partners. I'm a managing director in charge of business development and ESG practice. And SWEN Capital Partners is an investment firm specialized in responsible investing for private assets. So we invest in funds, but also directly in companies or project assets. And we do that both in private equity and we invest both in equity and in debt. And we are active in private equity, private debt, and private infrastructure markets. We manage, as of today, nearly 4 billion euros, and we are a team of nearly 30 people, with 2 people dedicated to ESG. So it's quite important to mention it, because it's not usual to see such a team with the level of our assets under management. So for SWEN, ESG is core to our business, because we not only do we aim high financial returns, but we also want to invest with purpose. So it's very key for us to deploy a strong, responsible investment approach. And we have a responsible investment approach, but quite a pretty simple one, because we deploy for all our institutional investment. So from the due diligence to the monitoring period, we deploy an ESG process with a deeply involvement in all the investment teams. So I mean that we are part of the team, the ESG team is part of the investment process, so sees all the different steps of an investment process. So we are aware of all the investment opportunities, and we are able to raise the hand and to say, no, it doesn't comply with our ESG requirements, and clearly we will not invest if the funds or the assets don't comply with our ESG requirements. So in terms of responsible investment approach, I think we have known exactly the same evolution from less formal to more formal process now. And the last evolution of this year is that we have been working on a climate strategy, so to reinforce our responsible investment approach to take into account these environmental, climate, new issues. So it means for us new engagement in terms of exclusions, but also in terms of allocation in the funds that we manage. We commit to allocate a minimum part of this size in solution that will help to finance new solution for a lower carbon economy. So quite strong engagement and quite strong constraint for the investment team to find the relevant investment, and the performance should be there at the end. So it's really new. We are beginning. It's quite an innovation part of our new investment strategy, but we are quite confident with this objective. Just to come back maybe on the purpose of this roundtable, and so how do we monitor closely our assets under portfolio? Just to give you some insights about the relationships we have with the GPs. We have today more than 140 GPs under our active review, and the underlying assets are much more higher because we are talking about more than 2,000 underlying assets. So it's a huge data at the level of financial data, but also extra financial data. So it's a huge challenge, the quality of the data at SWEN Capital Partners. So just to come back on the way we manage the monitoring process in terms of ESG. We will do that in 3 ways. The first way is the non-formal way. It's very much more classical. It's like the financial monitoring. We have regular interaction with our GPs, but also with the management of the underlying portfolio company or assets in portfolio. The second way is quite new because we put in place last year in our investment process. The second way is through our daily controversy monitoring. So it is based on news alerts that allow us to identify positive and negative signals coming from our underlying portfolio company thanks to web alerts. And so it's really powerful because, for instance, it allows us to identify some positive but really the negative impacts that can have an impact on our reputational at the level of SWEN Capital Partners, but overall at the level of our institutional investor. So, for instance, if I can, maybe I keep the examples for the next part because of the time.
That's a good idea.
Okay, so the third way.
Thank you for being sensitive.
So the third way and the last way to monitor is through our annual ESG reporting survey. So each year, between March and June, we ask to all our funds and to all our direct co-investment to give us a feedback on their ESG activities, but overall on their key ESG KPI at the level of the portfolio company, but also at the level of the GP. So we have score, GP score, ESG GP score that we monitor over the year to check that they are improving, and we will help them to find the right direction to improve in terms of ESG practice. But overall, at the level of the underlying portfolio company, also we have ESG KPI, and it's key for SWEN because it allows us to build our ESG infrastructure benchmark and allows us also to identify the major deviation at the level of the underlying assets in terms of safety or whatever the other ESG indicators.
Excellent. Thanks, Isabelle. Thanks for your sensitivity to the time. That was great. On to Leisel Moorhead from QIC. I'll advance your slide. You also have 5 minutes. Thank you.
Great. Well, hi, everyone. My name's Leisel Moorhead. I'm a partner in the infrastructure team at QIC, and I really appreciate the opportunity to speak to you today about how we go about integrating ESG factors into our asset management or during the ownership phase. QIC is a specialist institutional alternative manager with over $80 billion of funds under management. In the infrastructure asset class, we have 12 direct investments with about $9.7 billion of assets under management. As a direct investor, we really believe that integrating ESG factors into our ownership phase is really relevant for infrastructure assets. As Adam said, they have long-term lives, they provide essential services, and they drive economic productivity and growth. So managing a portfolio company's social license to operate in this context, we really believe is about driving long-term sustainable returns for our clients. As you can see, I'm going to talk to a case study today of our investment in the Port of Melbourne. But before I do, just a little bit about QIC's approach to responsible investment. We have a distributed model where we have a specialist responsible investment team. We have Kate here today, who's that. I sit in the infrastructure team, and within each of our asset classes, we have someone like me who champions the integration of ESG factors into that asset class. But our philosophy is to try and make sure that every investment professional understands what's important and material in relation to the particular asset that they manage. So it's really becoming, frontline people are making those choices themselves. But back to the Port of Melbourne. In October last year, QIC was part of the winning consortium which acquired the long-term lease of the Port of Melbourne for $9.7 billion. We manage, on behalf of our clients, a 40% stake in that asset. So first of all, we place a priority on governance, and this is something that we set up very early in our consortium discussions because it's the key to be able to influence the direction of the business in the asset management phase. Not just generally influence the direction, but equally on ESG actions and initiatives. So the slide outlines a very high-level overview of, gives you a flavour of our approach to integrating ESG through our investment process. And I've highlighted on the slide some of the factors that we considered, but I'm actually just going to talk to the factors, or a couple of factors more relevant to the actual asset ownership phase. So I've also highlighted on the slide some of the key facts relevant to the port itself, because this provides some useful context. Most importantly, it's a landlord port. So it manages over 500 hectares and it has over 72 tenants. So from a community and stakeholder perspective, it's a very large precinct with a large number of stakeholders. And even though it doesn't necessarily control all of the operations on the port, it's often the first party to be called if there's an issue on that particular precinct. So because it's actually the terminal operators and other port users that are responsible for their operations within their tenanted area. So one of the initiatives that we were able to implement early on is that when the lease renewals were coming up for renewal, we were able to implement terms where we required additional reporting. Sorry, 1 second. Remove the scarf.
The scarf.
I'll remove it. Hopefully that's it. We introduced additional terms into the leases to require additional reporting on environmental and health and safety incidents by the tenant, so the port was getting the information to understand what was happening. I'd also during the transition in a new ownership phase, it's a very, very busy time for management. And we're very conscious that although ESG factors might be very important to the business, they may not be the dominant issue facing the business in that early phase. So what our approach is to make sure that through our board representatives, because we always invest to get a director and at least one director on the board, through that, we were able to ensure that the board risk committee was established early on, that it also undertook a holistic review of risks across the business, including ESG risks, to make sure that there was an appropriate prioritization across the business. We're also, during this phase, we're able to undertake a specialist, an ESG risk review by our specialist responsible investment team. This focused more on engaging with management in looking at their policies, processes and procedures and reporting on ESG performance. So what was interesting in the outcome of that was, although the port had quite a lot of those processes and procedures in place, it was more about effective implementation. So our approach is to look at how we can work with management to get them looking at on a more proactive and forward-looking basis, and to ensure that they're looking at the social license to operate for the port on a more holistic basis. And lastly, it's hard to talk about a seaport without talking about climate resilience. So obviously it was one of the key risks that we identified very early in the actual due diligence phase, looking at both the impact of acute and chronic climate risks on the operations of the port, but equally looking at how climate might affect some of the key commodities of the port, which includes agriculture. So once we moved into the ownership phase, we were able to engage with management and do some more desktop resilience work and engage with them on things such as making sure that they're taking account of climate risk, capital asset management planning, and their maintenance practices, because all of those things lead to the resilience of the port. And the other important factor that we test across all our assets is looking at, there's resilience on one side, but there's also the preparedness for dealing with emergencies. With essential services that these companies provide, it's really important that their emergency response procedures are in place and can get the services back up and running as quickly as possible. So that was my quick example about how we go about in our active ownership, integrating ESG factors.
Excellent. Thanks, Leisel, and thanks for bearing through some technical audio challenges. It's funny to see all the panelists try to sit perfectly still so that no microphone glitches happen. So no one move for our last panelist. Dariusz, Prasek from the EBRD. We've invested alongside the EBRD and I've seen up close your ESG monitoring processes, so very thorough. In some cases, the multilaterals are the furthest ahead in terms of ESG practice, and so very excited to hear about your work. We have 2 slides for you, and I'll try to start with this one, then we'll go into the case study.
Okay. Thank you, Adam. Hello, everyone. I'm very pleased to be here in the beautiful city of Berlin. Let me first start with who we are. So you know we are one of the regional development banks. We have been created in 1991 to promote market economies in formerly centrally planned economies. But we have expanded somewhat the concept of Europe. We moved to Mongolia, we moved to Northern Africa. And yes, that's true. From the very beginning, we had sustainable development enshrined in the act establishing the bank. So this was the first regional bank with such a mandate. And we are AAA rated. You've got on the slides some important information. What I wanted to highlight that we went through the evolution of the process of transition. First, it was market, and market economy, promoting market where it wasn't present. Currently, we redefined transition, and in the last line, you see that we are promoting economies which are competitive, inclusive, well-governed, green, resilient, and integrated. This is the current driver of the bank. And just to give you an example, we have a commitment that by 2020, 40% of our investment will go to green investments. So this is what has happened over the 26 years that the bank has existed. We are not the youngest anymore. There are other banks. There are AIB, there is BRIC Bank, other banks. I've been with the bank for 25 years, and let me allow for one reflection on the transition process. When we had this market, when I started, our bankers, which were in SEAT and Harvard Business School graduate, they understood only 2 basic human feelings: fear and greed. Either they wanted to have money, or they were afraid that they can lose money or be punished in other way. Currently, we see more responsible bankers. If I say that we are at the end of this transition process, I would be lying, because we are not. We are definitely, there are still these fossilized bankers who still understand fear and greed, and you have to have carrot and stick, enshrined in many investments. So this is how we are. This is my little reflection, what has happened in the transition. As a case study, which I have chosen, it's actually financing large pipeline projects. I'll tell you why I have chosen this. This is mostly driven by the BTC and South Caucasus pipeline investments, which happened 12, 13 years ago. But these investments shaped actually the approach in the region, completely changed how both investors and contractors and other stakeholders started to approach. And we see this now when we are thinking of financing TANAP project, TAP project, and other projects. We call them Southern Gas Corridor. We see completely different approach. And I would like to, I don't want to go through all the points I put here, but I wanted to share with you a few lessons learned. The first one, early engagement is very important. Early engagement in terms that when you think about investment, at the stage of a concept of an investment, you have to start thinking about environmental, social, governance safeguards built in. If you do it retroactively, you waste a lot of time. And it is not a secret that in a BTC project, which was developed with some elements at the beginning, when the international financial organizations were approached, the lenders group, actually we said, hang on a second, it's not there yet. It has to be, first of all, fair, safe, and sustainable. When I say fair, it has to be fair for investors, but it has to be fair for the communities that the pipelines go through. It has to be safe at the stage of construction and operation for the community. And sustainable, it has to create businesses which continue after the pipeline is buried and transporting the oil or gas. So we put the brake on, and the investors lost, I would say, about a year and a half. You know what is a year and a half in a case of investment of that size. Now we see that this is all enshrined at the very beginning. So that's why I'm saying early engagement is very important. The second, I would like to go to the last one, linking the disbursement to the agreed environmental social action plans. This is stick and carrot. But what really is important, what is the key lesson, that it has to be a win-win situation. It has to be good for the investor, it has to be good for the contractor, it has to be good for those who provide project financing. So I spent personally a lot of time when we select monitoring consultants that they actually are really good. I spent a lot of time reviewing terms of reference, going with the consultants to the field, because only when they provide meaningful information, which is not only useful for us, ticking boxes or checking or punishing or trying to have our environmental social action plans on track, but when it is useful for both the developer and the contractor, when this monitoring gives actually advice to improve the project, when you have the real win-win situation, only then you have buy-in from all stakeholders, and only then you can have a responsible investment which enshrines all the appropriate safeguards. This is my brief intervention.
Excellent, excellent. Thank you, Dariusz. Very helpful. We have a handful of questions through the app. I encourage you to pose new questions and also vote on the ones that are already there. While you do that, I'm going to jump into some questions that popped up during the first panelist presentations. Isabelle, I have a question for you, and I'm going to speak slowly so you have as much time as possible to think about the answer. You invest directly and through funds. Who has it tougher? Do you hold your managers to a higher standard than your direct investments, vice versa, or are they exactly the same? And how do you think about where best practice is led?
Interesting question. Well, in fact, I think we have seen evolving the market and our investment universe in terms of ESG profile of the GPs we invest in now. So from the beginning, when we started to have this strong ESG approach, we were more on a progress approach. So we selected good fund managers that were open to put in place an ESG approach. So it was 5 to 6 years ago. And now, after this year, encouraging the markets of the GPs and so the ESG practice that they deploy on their portfolio, now we are moving to another type of investment approach. So we are much more demanding on the ESG requirements, and we are much more demanding on the ESG disclosure about our GPs. And so now we are much more selective in terms of profile, of ESG profile of the GPs we select. So we are moving with the market, and now we think we can be selective also at the level of ESG. And so it's much more constraint. It's much more an opportunistic view also, because we are sure that selecting these good GPs will help us to have better performances over the long term. So regarding the evolution of the ESG profile of the GPs, we have seen moving an increasing of the level of the ESG score of the GPs, and now the ESG profile of the portfolio we manage are much more higher than 5 or 6 years ago. So it's a way of answering to the question. And just regarding the direct co-investment, as we make direct co-investment alongside the GPs we are working with, so we know that being with them directly in the equity of this investment or with mezzanine debt, we know that there will be a deployment of a CSR approach. So we are much more comfortable to be part of the financing pool in direct co-investment.
Got it. Makes sense. Makes sense. A question for you, Joe, about your monitoring, your assessment framework. I mentioned getting into the guts of it, and it sounds like you have a nice systematic framework. I'm curious if you can take us into a real-life example of where you felt like there was a meaningful difference in a manager's practices based on your assessment and review.
Well, yes, certainly. I think one of the features of our assessment framework is that we're really trying through that to understand our manager's approach. So, how does the manager actually undertake their own monitoring and their own asset management sort of activities? So it's understanding the touch points, so whether they're on the board of an asset or the type of reports that they're getting from management. And we're wanting to see really, and I think over the time that we've had this assessment framework, we've really seen much more integration of ESG within those sort of key touch points. So whether they're board papers or asset management reports or risk assessments for assets. So we're really, I think, the main, one of the key areas of development and strength of managers over that time frame has really been seeing demonstrable evidence of ESG integrated within those sort of touch points and processes, and understanding how the managers are really interacting on a regular occurrence with those assets.
Okay, great. I'm going to move over to questions from the crowd. Thanks for all your participation and voting. By far, the top question is about GRESB or GRESB, pronounced both ways. I don't have a preference. The question is, what do you think about GRESB infrastructure? And for those who don't know, in 2016, GRESB, which was in real estate at the first industry-wide real estate sustainability assessment, moved into infrastructure and tried to adapt their framework for the infrastructure asset class. So any opinions or experiences with GRESB and how effective that framework is as a tool to promote ESG practices?
I can perhaps start. So we've been a member of GRESB property since for the last few years, and we find it extremely valuable in the property sector in terms of it providing a standard sort of framework for getting information from our property managers through to our ESG assessment. So in that asset class, we don't actually survey the same way that we currently do in infrastructure. So we rely on GRESB to provide that sort of underlying data. So we're not taking the GRESB assessment and saying, we don't need to do our own assessment anymore because we've got that. We're actually just pulling that sort of raw data through. I think, the feedback we're getting from managers is that, while there's always areas of improvement for these things, it really does reduce their reporting requirements because they're not getting all of the asset owners asking them to complete different surveys. They they love to be able to compare themselves with their peers through the GRES process. And in terms of the improvement in managers' responsible investment, ESG performance through the GRES process over the last couple of years in our property area, it's been huge. So the managers have really increased their scores a lot. So we're definitely looking at it in infrastructure. I think the difference is we have a much smaller concentrated portfolio of infrastructure managers, so we have much greater relationships. There's less assets generally in the portfolio, so there's perhaps a little bit less need, but some of the benefits we've seen through the property area, we really want to see coming through infrastructure as well.
Okay, so you're evaluating it for next year, possibly for your infrastructure.
Absolutely.
Any other experiences or perspectives on GRESB?
At SWEN Capital Partners, we are not using, I will say, yet GRESB, but we are looking at this because, in fact, we have our own ESG data gathering process, thanks to another tool that we developed with an IT company, because we developed it first for the private equity sector. So we are looking at this initiative, and for sure we will have to have a matrix of correspondence between our current scoring model and the future one.
Why would you switch from your own proprietary version to GRESB?
I'm not sure we will,
Yeah.
because in fact the major part of our investment in infrastructure with the GPs are not yet also in GRESB. So we will have to see and to move in the same direction and at the same time with the majority of our GPs in portfolio.
Got it.
To GRESB.
Great. Okay. Leisel, Dariusz, experiences, perspectives on GRESB?
We are driven completely by standards set by our shareholders. So it is very much aligned with other IFIs. So that's why, it greatly helps when we have an investor who actually sticks to certain type of principles, but, we will not use them.
Got it. And Leisel?
I think I can add that as an investment manager, a number of our clients have an interest in us completing the GRESB survey. Some of our assets have, in fact, completed them, and we're sort of investigating. I think we're moving closer to it. I mean, certainly on a real estate side, similar, our real estate fund is very used to reporting under that and definitely has seen the benefits. Infrastructure is much harder to fit in a neat little box, and so some of the frustrations in the survey is the lack of materiality and assessment. But we're overall, I think that it's a positive thing to have a standardized survey. You've just got to work within the survey as it exists.
Got it. And a related question that came in from the audience is about KPIs. And that challenge about, it's a diverse asset class within itself. So maybe, Leisel, you can kick off this question. How do you think about what you might call lowest common denominator KPIs that apply across a lot, and how to report those out versus tailoring them per asset class? How do you find material, interesting KPIs to gather, both for the monitoring and management, but also for reporting out to clients?
Yeah. Well, I think infrastructure is a very heterogeneous asset class, but there's some very consistent themes across all of them, and probably number one is health and safety. Across every infrastructure asset, it's a very high-risk operating environment generally, so that is one of the key KPIs that we require at the board level that it tracks, and then we're working out how to certainly report that up on a more regular basis to our investors. The other one, equally for infrastructure, again, a consistent theme is environmental incidents and responses to that. So even though every asset will have its own material risks, there are some very consistent themes which I think we should all be focusing on measuring.
Okay. Other thoughts on data KPIs, how you think about lowest common denominator versus maybe tailored per asset? How have you tackled the data challenge, Dariusz?
If I can comment on one aspect, it's very important that we are transparent and we communicate well. So when you have indicators, when you have independent monitoring, it's very important that actually it's communicated to all stakeholders. First of all, to the affected communities, but also to others who are interested in these assets, in these type of investments. In the past, a lot of misconceptions, a lot of resistance to investment was coming from lack of information, lack of communication, or lack of transparency. So this is an aspect that I would like to stress is extremely important in this type of investment and management.
That's a very interesting point, because I think in ESG reporting there tends to be a bit of a marketing rinse, doesn't there? Mm-hmm. We tend to be very forthcoming about positive news, but less so on the negative news. And naturally in this asset class you have a lot of tough environmental incidents, health and safety incidents. Could you talk a little bit about whether you've seen or observed bad things happening, like a fatality, like an environmental incident, and how you've seen that handled up through the reporting or communication chain in a good way or in a bad way, or just so we can draw a lesson from?
I can talk to both of those.
Great.
I've sat on the board of a construction project of a tunnel where the contractor had a fatality, and I can say that we reported that straight up the chain, straight to as much to our board, but equally up to the investors, because it is such a serious incident. I guess the question is both whether it's an environmental incident or a safety incident. The important thing is how you respond and how you manage that. Certainly we've had other instances where there's been environmental incidents, and it's as much about sort of it requires very active engagement following as well, to make sure that you've got, understand why it happens, understand how you can make the change to try and make it not happen again. But, it's really about having systems and processes in place to endeavour to prevent those things happening.
And could you take us inside that example a little bit more detail? Just you mentioned that there was a contractor, and this is a topic I think very relevant for infrastructure, where you tend to invest maybe in a holding company or an SPV, and then you have multiple layers of legal structures that actually carry out the work, and sometimes it's a subcontractor where a health and safety incident might happen.
Absolutely.
So the investor may have no legal liability, they're protected, and your investment colleagues may say, hey, we're fine, we're protected legally and financially, but morally, of course, you're not, and you have a lot of gravitational pull. So, you explain your influence and role in that.
Yeah, no, absolutely. And so whilst that sort of corporate veil exists for the investors, it doesn't exist for me, who I sit on the board. So I have very personal responsibility for being very close to understanding the systems and workplace health and safety systems that the contractor has in place. And we undertake, it is a very large construction project. It's a 5-year construction period. So very early on, even in the choice of contractor that for the main design and construction contract, how you go about evaluating to ensure that they're a reputable contractor that has the right systems in place, and then diligence their practices and processes and procedures, to the point where I went through myself the safety induction program to understand how they're inducting all of their employees onto the site as well. But the challenge is, and this one particular fatality was a very sad incident of a very experienced contractor, employee of the direct contractor, but you're absolutely right. The challenge is filtering that safety and systems and processes down to all of the subcontractors as well. But ultimately, all roads lead to the actual board and the legislation in Australia. So we stay very close to it.
Great, thank you. Isabelle, I've got a question for you. I'm going to throw you the next audience question. And it's about this little program called the SDGs over at the UN. A lot of questions about, how do you view these? It's very early stage for everyone. If you were in the plenary session just now, there's a understanding that everyone's trying to figure out how to put these to work. Infrastructure, on one hand, is actually part of one of the SDGs, and so it's a natural fit. So are we saying, oh, great, we fall into a box, we're done? How might you think about putting this into practice and measuring it?
Well, interesting challenges also for us for the next few years. In fact, it's the first year we introduced in our annual ESG report the SDGs for the infrastructure funds we are managing. I have to say that honestly, no one from our underlying GPs reported this year about SDGs. It was one or two times mentioned in the annual ESG reporting, but not developed. And so it's one of our first challenges for the next year. And it's ready to also modify our investment strategy to take into account the SDG, just to give more sense, more meaning in the way we will allocate, we will build our portfolio. Just to tell you how we introduce the SDG this year in our annual ESG reporting, I would say we have been very simple in the approach. We try to identify the assets that answer to the different SDG. But we are not yet in the way of saying that we will address at the level of the investment decision, we will address this SDG, this one, and this other one. It will be the next step.
Got it. I see maybe an energetic question from the corner. Was there a hand raised?
Yeah.
Sure, why not?
Martin Vierfer from KPMG. One of our clients from ORT, they made an impact assessment in Costa Rica of the terminal project that they did, and they assessed the societal impacts in monetary terms using the true value assessment, and they use this also to demonstrate their contribution to society and SDGs and so on. Is that something that would be feasible also to move forward, and also to you in the tendering process? May that be in a requirement for the companies to show the societal value that they anticipate to create in an infrastructure project, and that you actually may monitor the actual impacts achieved in the project?
Who would like to field that one from the panel? Anyone? Dariusz, sure.
I can start. Okay. Of course, this type of investment, when you ask about SDGs, actually every single project which is assessed by the bank, which is assessed by our economists, lawyers, and everyone else. When I mentioned to you the 6 transition qualities, has to be, and all these transition qualities have been assessed against Sustainable Development Goals. So the project has to score at least 60 points out of 100 on at least 2 qualities to be able to proceed. So benchmarking under the social study of these elements will definitely facilitate raising financing for such a project.
Got it. Great. Yes, Leisel?
Look, I think it's actually really important, and it's kind of separate to the SDGs but related in the sense that infrastructure and private sector investing in infrastructure sometimes cops a bit of a bagging from the media, but it comes back to your point, Dariusz, is that I don't think we clearly communicate as best we can some of the positive impacts that we have on the community. So I think there's a natural fit there that we could do better to communicate that, to help sort of grow the industry more generally as well as the positive impacts that is happening.
Great, thanks, Leisel. And a question here for you, Joe. I think it's a very practical one. When you hire your managers, did you always have this original ESG conversation when starting, or were there instances where you hadn't had that conversation initially and you had to sort of say, we have some new requirements, and how did that onboarding transition process go?
No, we've always had, since I've been at HESTA, always had ESG as a really core part of our manager selection process and appointment. But there's always changes, and there's always changes, at managers. So, I'm thinking one of our managers that was a real leader in responsible investment at one point, then, just through staffing issues, things became, it changed at that manager. And it really took some time engaging with them and communicating the important, re-communicating, the importance of responsible investment and ESG back up through their investment team and up through to the, ultimately to the management about how important it was. And, since that time we've seen, really great, re-engagement more so. I mean, I think within infrastructure, there's a lot longer history of integrating ESG. It's very tangible. So there's always been that sort of foundation, but really seeing sort of the way it's changed in particular managers over time and getting some improvements, seeing new resources come in. For example, over the last probably 18 months, we've seen, 2 of our 4 key managers introducing climate change risk assessments that cover both climate resilience and carbon footprinting. And so seeing some of those real changes over time and supporting those and providing the feedback of where we expect more of the same, and ultimately, I think on the reporting side, we haven't put requirements on managers, but asking them to report what they see as material in their portfolio. But I think over time we'll sort of either use GRESB or sort of start sort of applying some reporting requirements to get that portfolio-wide view of that.
Great. Okay, and for those who don't use GRESB, there's a question also about benchmarking. So we're collecting all these KPIs. Maybe our LPs are perfectly satisfied that they're just seeing numbers. But how do we make sure that these are meaningful? How do we benchmark these numbers, say health and safety performance? Isabelle?
Yeah. So we don't use GRESB, but we have our own system, and so we can build our ESG infrastructure benchmark. And so for each of the underlying assets, we check the deviation from the benchmark, and we try to identify the signals. In fact, it's a way of having signals coming back from our underlying portfolio. And so when we have identified a signal, so quite large deviation from the benchmark, we should consult the GP in order to check before if it's not an error, because it's reporting data, so it may be an error at their level when they complete our annual ESG survey. And if it's not an error, we have to know how it happened in the portfolio, why, and what are the following actions they are putting in place in order it will not happen again. So it's key for us to close the incident, in fact. And just coming back about this type of regular reporting, regular interactions, more formal interaction each year, we can see really improving the market in terms of transparency and willingness in communicating more proactively ESG information. And coming back to fatality, for instance, 3 years ago we had in our portfolio a GP that encountered a fatality in this portfolio, and we only knew it months later in the annual ESG report. So good, they had an ESG report, but it wasn't.
Could have done earlier.
No, it was too late. So that's why we came to this incident, this daily controversy monitoring process, in order to check, to track, and to identify more earlier, in fact, this type of incident. And so it would depend on the significance of the controversy, but also of its frequency. And if it's significant, frequent, in the same day we have, for instance, I was thinking about one asset we invested in directly alongside a GP we have been working with for a long time. It was a boat commuting between islands, and we have 2 fires in a very limited period of time on a boat. And the day we had this news alert regarding this second fire, the same day we had the GP on the phone to ask him what happened. Excellent. And what was the action plan. And so, well, in fact, we were satisfied by the answer, but it's just to show you that this interaction is always evolving. Yep. And it helps, I think, and I hope, the market to improve in terms of transparency and communication to all the LPs. So it's a way of getting more information, and it's a way of making progress all together in communication to all the LPs.
Very good, very good. And with that as the last comment, we're going to conclude the panel just 1 minute over. Thanks to our distinguished panelists for your contributions and perspectives. Quickly to sum up, reminder that the Infrastructure Advisory Committee of the PRI is coming up with guidance by end of year, launch events Q1 of next year. If you have questions, Hilke in the front row can talk to you, and feel free to come to the forward with any questions for our panelists. Thanks so much.